Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets that keep big companies ticking, or sometimes ticking backward. Today, we're diving into Jefferies Financial Group's latest report, and let's just say it looks like someone's been busy issuing debt. Alright, so Jefferies Financial Group Incorporated, a name you might recognize in the world of finance, has put out their latest update. We were looking at a form called an 8K, which is basically a heads up about important company events. And the big news here revolves around their financial results for the quarter and 9 months that ended the 31st of August 2025. This report was filed right at the end of September 2025, and it is telling us about how the company was doing up until the 31st of August of that same year. Now, before we get into the numbers, let's quickly look at what Jefferies actually does. They re a major player, and their stock, traded under the ticker symbol JEF on the New York Stock Exchange, represents ownership in the company, but they also have quite a bit of debt out there also listed on the NICE. We were talking about 4.850% senior notes due 2027, 5.875% senior notes due 2028, 2.750% senior notes due 2032, and 6.200% senior notes due 2034. That is a lot of different loans they've taken out with different interest rates and different years they need to pay them back. Think of it like a personal piggy bank with several different loans on it. The core of this filing, the juicy part for us, is in item 2.02, which discusses their results of operations and financial condition. Essentially, they're retelling us how the business is performing. They've attached a press release that details their financial results. Now, this press release itself is the star here. While the filing mentions it is filed to inform, it is important to understand that this information is being furnished, not filed, in a way that makes them strictly liable for it under all circumstances. This is common for press releases so companies can share news quickly. From what we can gather from the nature of this report and looking at typical filings like this, the key takeaway is their financial health. They've issued several types of notes, which means they borrow money from investors and promise to pay it back with interest. For example, they have these Bawling senior notes due 2027, which means they owe money that needs to be paid back by 2027, and they're paying about 10% Bawling interest. Then there are the Batiwu senior notes due 2028, paying a higher interest rate of 5.5%, and so on. The more notes they have outstanding, the more debt they carry. So what does all this debt mean? Well, it means they have significant obligations. They have to make interest payments regularly and then pay back the full amount when the notes are due. If the business isn't doing well, or if interest rates go up, managing all this debt can become a real challenge. It could limit their flexibility to invest in new opportunities or even keep the lights on if things go south. On the flip side, taking on debt can allow a company to grow faster than it could with just its own cash. If Jefferies is using this borrowed money to make smart investments that generate more profit than the interest they're paying, then this debt could be a good thing. It's a balancing act. You want to use leverage, which is using borrowed money to increase potential returns, but not so much that it becomes a huge risk. Now let's consider the common stock member part. This refers to their shares, the actual ownership stakes in Jefferies Financial Group. When a company issues stock, it is a way to raise money without taking on debt. However, it also means diluting ownership, meaning each existing share owner's piece of the pie gets smaller. The dates we see repeated, September 29, 2025, and August 30, 2025, are crucial. August 30 is the cut-in off for the financial results, and September 28 is when they're reporting it. This gives us a snapshot of their performance at a specific moment in time. Thinking about this from a Warren Buffett perspective, we'd want to know if Jefferies is consistently generating profits that are significantly higher than their cost of borrowing. Are they effectively using the money they've borrowed to expand their business or gain market share in a way that benefits shareholders in the long run? We'd also be looking at their cash flow. Can they easily cover their interest payments and other essential expenses from the money they bring in from their operations? If not, that is a red flag. It is also important to remember Jefferies Financial Group operates in a highly competitive and cyclical industry. Market ups and downs can significantly impact their revenues and profitability. Understanding their strategy for navigating these cycles is key. Are they diversified enough to weather a downturn, or are they heavily exposed to one particular segment of the financial market? In essence, this report, even without the specific numbers from the press release being detailed here, is a signal. It is Jefferies telling the world, here is how we're doing, and here is what we owe, and here is who owns us. The results of operations part is where the real story lies, and it's crucial to see if their debt levels are justified by their earnings power and future growth prospects. If they continue to issue more debt without a clear path to increasing profits, that's a sign to be cautious. On the other hand, if their earnings are strong and growing, and they're managing their debt wisely, it could indicate a healthy and expanding business. The filing also lists the exhibits. The main one for us is Exhibit 99, the press release itself. That is where the actual numbers, the dollars and cents showing their performance would be. The other exhibit, 104, is an interactive data file, which is standard for making financial information machine readable. Looking at the overall picture, this 8K filing is a standard procedural step. The real meat would be in the Exhibit 99 press release. Without those specific figures, it is hard to give a definitive financial analysis. However, the structure of the filing indicates they are reporting their financial results and the types of securities they have outstanding, both stock representing ownership and various senior notes representing debt. This tells us it's a company that uses both equity and debt financing. My take upon seeing this kind of filing is that while the company is actively managing its capital structure, issuing notes and having common stock, the true story is in the performance metrics. The success of Jefferies hinges on their ability to generate enough income from their operations to service their significant debt obligations and provide returns to their shareholders. The risks are inherent in the financial services industry, which is sensitive to economic conditions and regulatory changes. Opportunities likely lie in their ability to adapt to evolving market dynamics and capitalize on strategic growth initiatives. The conclusion from this filing alone is that Jefferies is an established financial entity with a complex capital structure, and its true performance and future direction are detailed in the accompanying press release. Alright, that is our breakdown of this Jefferies Financial Group Inc. filing. What is your take on how companies manage debt and equity? Drop your thoughts in the comments below if this analysis was valuable. Hitting that like button really helps us out, and subscribe for more deep dives into the world of corporate finance. Don't forget to check out our Discord community linked in the description for even more discussions and insights. Thanks for watching. See you next time.